I'm just going to make a few brief introductory remarks to our presentation, and really it's to mention that overall our programme of research at NEF has been, since the crisis, looking at the banking industry for obvious reasons. And I just want to remind you about a couple of things from the point of view of economics about banks, because banking is a very unique industry. We like to refer to it as the operating system of the economy. It's not really analogous in that sense to shops or selling TVs, because the provision of payment services, transaction banking, and the provision of credit are fundamental to the operating of the economy, and they're also fundamental to social and environmental outcomes that we all seek to achieve. And economic theory suggests, of course, that free market competition will give us an optimal outcome. And in general, that may well be true, but the assumptions that requires, if you look at them, are that there are minimal transaction costs, perfectly rational consumers, perfect information, and perfect competition. Now, none of those aren't necessarily true of many markets, but in banking in particular, it is the case that the strong public interest that we have in a banking system serving all the areas of the economy, in theory, there's no reason why we should predict that if we only have one kind of bank, which is a large shareholder-owned profit-maximising bank, and that's all we have, there's no reason in theory why we would expect that that would serve all of the corners of our economy and society. And indeed, when we look in practice, we find that it doesn't. However, of course, the good news is that there are plenty of ways, and commercially viable, financially sustainable ways, I might say, not taxpayer funded necessarily, forms of banking provision which can fill all these gaps. And we know this because we know this practice exists already on a much smaller scale than we'd like in this country. But we also know it because we can look overseas and we can look at all sorts of models that are really interesting and from which we can learn lessons. We're used to, of course, to looking to the US, and we'll hear a lot more about that later. But the piece of research that we did tried to look all around the globe, in fact, and identify different forms of what we called stakeholder banks. Banks that serve a range of stakeholders, customers as well as shareholders. And we found some very interesting commonalities between these sorts of banks that operated in a really sound commercial way, but were able to serve those areas of the market that were not getting properly served by the commercial banks. But these sectors are complementary. They work alongside each other. And that is, I think, in a sense, a vision that we have at NEF for the UK, that we have a more diversified banking sector where the community investment sector can grow and can provide good services to those areas which are currently not getting them. And so with that, I'm going to hand you over to my colleague Lydia, who will give you the insights from our research. Thank you.
So as Tony's described, this piece of work that we did, where today we're going to be talking about specifically the community investment side of things, but it actually, is this working? Yes. It actually formed part of a wider project where we looked at all the different types of, or the main different types of alternative financial institutions that exist in different countries. And by alternative financial institutions, I mean alternatives to the very large national banks that we have in the UK that are all listed on the stock market. Now, as Tony described, we found that the situation we have in the UK, where we have a very homogenous financial sector, where there are some interesting institutions covering those gaps that Ed talked about, but they're more on the sort of the margins, the peripherals of the financial sector. That's not the case in a lot of other countries. I mean, we just pulled up a few examples here, but so you can see the UK. With its almost entirely dominated by commercial banks on the right-hand side. France in the middle, which has a more even split between cooperative financial institutions and commercial banks. And then Germany, which has this three-pillar system with cooperatives, commercial banks, and also local, small, government-owned savings banks. And so looking across all these different countries, there were 4 main types of these stakeholder banks. These banks that don't just maximize profits, banks that are financially sustainable, but also have other goals as well. And the 4 types we identified were cooperative banks, credit unions, savings banks, and CDFIs. Now, to talk you through some of the sort of findings and conclusions that we got from this, we're actually going to take credit unions as a case study, because it quite nicely pulls in a lot of the themes that emerged across all of them, but also because you're going to be hearing a lot about CDFIs, both in the presentation that follows this one, but also then later on in the day from Mark Pinsky. But first of all, just to talk about some of the kind of core advantages that emerged across all these different types of financial institutions, before we then go on to talk about, well, how have they become prominent, how have they become sustainable and got weaned off grant funding in other countries. So why are these institutions good? Well, firstly, a lot of them, particularly the cooperative ones like cooperatives and credit unions, have democratic ownership structures. So they're owned by their customers rather than remote shareholders. And they operate on a principle of one member and one vote. So you can't just sort of buy up all the shares in the institution and control it. And it means that with a relatively small amount of money, you can buy a stake and have a meaningful say in the institutions that impact on your life. They also, as we described, maximize not just profits, but also other values like customer service. And the way that they put these incentives into their institutional structure is they don't allow the owners to have a claim on the profits and the capital of the banks. They have a claim on the money that they themselves have put in, and they might get some dividend payments to compensate them for tying up their money, and so they don't lose out as a result of inflation, but they can't benefit from large amounts of profits that the bank accrues. And that means that affects the behavior of these institutions. So for example, you see things like lower risk taking, less of the short-termism that blights the commercial banking sector, and across all the different types of stakeholder banks, you see generally lower on average returns than the commercial banks, but much more stable returns. And similar high capital levels, because the owners don't have a claim on the profits, they are more incentivized to put them aside in case of a rainy day, but also to build up what they look upon as an endowment for future generations. And as a result of these factors, when you look at the behavior of stakeholder banks and how they performed during the financial crisis, they were actually often able to expand lending, increase lending, whilst commercial banks were withdrawing lending. So, I mean, I've just put one example up here on the slide, which is of American credit unions expanding lending by 7%, whilst commercial banks cut back by 7% in 2008. But that's just one example. So you see similar statistics coming out of Canadian credit unions, coming out of German and Swiss savings banks, coming out of a lot of cooperatives. So that is a trend that emerged across, obviously with some exceptions, but was a general theme coming out across the groups. Similarly, because these institutions tend to be smaller and restricted to a local area, either specifically by legislation or because they're owned by the local community, they tend to be much better at being in tune with local people and their needs. So, for example, if you're a bank and you can literally only operate within a small part of the country, and you can't go off and make easy profits in a sort of a more affluent area of the country, then you really are forced to get to know that local area, get to know that local economy. And there's lots of empirical studies out there that show that these sorts of institutions are better at getting the soft information that means that they can get more money, both lend proportionately more to institutions like SMEs, but also lend better. So when you look at their default rates, not only are they lending proportionately more to SMEs, they also suffer less defaults. And once again, this is something that you see across lots of the different types of stakeholder banks. So I've once again got an example of credit unions there. So I've got Canadian credit unions have approximately 17% of the SME lending market, despite holding only 5% of the total banking markets. But once again, this is just one example. And if you look at the lending statistics from savings banks, from cooperatives banks across Europe, for example, you see very similar statistics emerging. And this is just a graph to illustrate the stability point I mentioned before. So this is a graph of European cooperatives and their earnings versus the rest of the banking system. And the European cooperatives is the orange line there. So you can see it's lower on average, but more stable returns. And similarly, this is just one graph to illustrate the lending statistics that I was talking about. So this shows German savings banks, which is the blue line there, expanding lending, whilst German commercial banks, which is the red line, decreased their lending. But that was just sort of to introduce the sort of general trends emerging. But to talk more specifically about community investment, taking the example of credit unions, and starting to look at the questions of, well, where are these institutions prominent? Where have they thrived? Why have they thrived? How have they weaned themselves off grant funding and become financially self-sufficient? First of all, just to briefly introduce what they are. They're a type of financial cooperative, so they're owned by their customers, but they differ from cooperative banks in the sense that they can only provide services to their members who have to share a common bond. So that could be a common bond based on where they live, who their employer is, their religion, but you have to be a member of a credit union to use their services, whereas anyone in the general public can use a cooperative bank. And this is partly because credit unions believe strongly in creating a sense of solidarity amongst their members, but also because they're often classified in many countries as non-profits, and so receive tax breaks from the government, and that means that there inevitably is also formal restrictions placed on them by governments. And in actual fact, there's been, to take an example from the US, in the US, where credit unions are much more prominent and are actually sort of real competitors to the small local commercial banks, they've actually taken real issue in the past with credit unions when they've sort of strayed outside of their, or perceived to be straying outside of their formal mandate. So for example, in 1994, commercial banks in the US went to the Supreme Court to complain about credit unions who they felt were being too flexible with how they'd interpreted the common bond. So whilst there's credit unions and community finance institutions in the UK sort of work quite sort of collaboratively, I would say, with commercial banks, because they sort of fit into commercial banks' corporate social responsibility sort of compartments. In other countries where they're actually real sort of prominent competition for the commercial banks, there can sometimes be a much more controversial and conflicting relationship there. And final point to make is that they emerged out of self-help movements. So they emerged in Europe because in the 19th century, because commercial banks were failing to serve rural communities, failing to serve low-income communities. And so these people, rather than waiting around for other people to sort of help them out, they said, well, we can help ourselves. And so they sort of built the social capital to do that. So where are they? Well, we looked at two measures of sort of the prominence of credit unions in different countries. First of all, we looked at the percentage of populations who are members of credit unions. And you can see from the graph here, by that measure, countries like Ireland, with 72% of the population as a member of a credit union, come out on top, followed by Canada and the US, with 46% and 45% respectively. And the UK does really rather badly by that measure, with only 2%. But taking a different measure, which is looking at the value of those loans as a percentage of GDP, things have changed slightly. So in this case, it's no longer Ireland out in front. Ireland actually sort of slips to the middle at 4%, and it's instead Canada that emerges way ahead at 16%. And unfortunately, by this measure, in the UK, credit unions are virtually non-existent, with a magnificent approximately 0% of GDP. So the question is sort of why is this the case? Why why 46% of the population of Canada members of a credit union and 2% in the UK. There are a variety of reasons why this is the case. Some of it due to sort of history and the regulatory environment, and some of it to do with the way that the sector has actually sort of behaved and organised itself. So firstly, just to sort of talk about sort of the historical advantages that some of these countries have. There are enormous differences in terms of when these institutions were introduced in the various countries. So for example, whilst cooperatives started off in Europe, whilst credit unions started off in Europe, they actually then developed into cooperative banks, and so sort of no longer stayed credit unions, which is why in continental Europe there isn't a particularly large credit union presence currently. That was then followed by credit unions developing first in Quebec in Canada, but then spreading to the rest of Canada, and then actually immigrants from Quebec moving to New Hampshire and starting credit unions in the US. And this all started sort of in the 1900s, but they really took off during the Great Depression. But what's interesting is that not only were these institutions arriving in the 1900s, it was very soon after they sprung up that they managed to push for legislation and regulation. So, for example, in the US, credit unions already had some legislation in place for them by like 1908, although they didn't get their first regulator until the 1930s. But the picture's quite different sort of across the pond when you look at Ireland and the UK. So for example, credit unions didn't start in Ireland until the 1950s, so that's an enormous lag from places like Canada and the US. But though they did do better than the UK ones in the sense that they relatively swiftly, within 10 years, got legislation specifically for their purposes, although they then weren't regulated until 2003. In the UK, we didn't get credit unions until even later. We got them in the 1960s. They were started by Irish and Jamaican immigrants. And they originally, there wasn't any specific legislation specifically for credit unions. And in fact, it didn't come in until the late 1970s. So before then, they actually just were classified as friendly societies, and they just came under the registry of friendly societies, which as it sounds like, pretty much registers them. And there's not much else to it. So, so they didn't really get any proper legislation at all until the late 1970s, and weren't regulated until 2002. And in fact, even the legislation that was introduced and the regulations, it was quite out of sync with that which was found elsewhere around the globe. It was much more stringent, and it wasn't until actually January of 2012, so early last year, that the legislation was amended to make it more on a par with that found elsewhere around the world. So in terms of both the sort of historical background and the regulatory environment, the UK is at a huge disadvantage and has been to places like Canada and the US, although we are now at least at a place where regulation-wise we're on a more equal playing field. But to sort of move away from history and regulation and look at the industry itself, the sector, and how does it organise itself. And this is very interesting because it was a trend that emerged not just for successful credit unions, so the credit union sectors in Canada and the US, but also across other types of stakeholder banks. So for example, cooperative banks in Europe, they operate, there are lots of little autonomous, localised cooperatives, and they collaborate together and for some activities and form central institutions where they can pool some things in order to achieve the economies of scale. So it's trying to resolve this tension between getting the efficiency and economies of scale to enable them to compete with commercial banks, but at the same time not achieving that by mergers and acquisitions and losing their local element, losing their connection to the local communities. And they've done that by remaining small, localised and autonomous, but collaborating in certain things. And I've given examples here. It can be everything from liquidity management to risk management, to accessing the payment systems, to marketing, to PR, to lobbying. And these institutions are generally called centrals. So for example, in Canada, they're called centrals. In the US, there are two different types. There's corporates, which basically provide the liquidity functions, and then there's CUSOs, credit union service organizations, that provide the more sort of operational economies of scale. And so most savings banks and cooperatives operate on this principle. With credit unions, the successful ones, like the Canadian ones and the US ones have, but they have this centralized infrastructure has yet to really materialize at all in countries like the UK and Ireland. And because we don't have this sort of infrastructure, it's very difficult for credit unions to be able to be financially sustainable and offer things like transactional banking, so current account services, which are exactly the products that are needed in order to diversify the membership base and in order to get the customers who are going to enable the institution to be financially sustainable. So it can still have its social mandates, but not be so reliant on grant funding. And in order to do that, it has to be able to offer current accounts, because realistically, a very small percentage of the population are ever going to want to be members of institutions where they can't have a current account. So this is really an enormous hurdle. And at the moment, credit unions in the UK have to access the payment systems via the cooperative bank, but it's not an efficient system at all, and most of them are actually operating currently at a loss. But just to wrap up, you've got to remember, of course, that there's no such thing as a free lunch. And so whilst these central institutions have lots of benefits, there are also a few sort of downsides you've got to watch out for. Because whilst they're owned by their local institutions, and so theoretically should be controlled by the local credit unions or the local savings banks, cooperative banks, they of course do also then, as they grow and become more important in the network, start to exert control over the local institutions themselves. And so the degree to which the local institutions actually remain sort of localized rather than controlled by a centralized network varies a lot around the globe, depending on sort of the different dynamics. And also you've got to watch out that these institutions don't take on a life of their own, because often because they're engaging in sort of the wholesale banking type activities and hiring the sorts of staff that would work for like investment banks, for example, a lot of the cooperative bank centrals, for example, started getting involved in sort of the securities that got everyone into trouble in the financial crisis. So there are downsides. You have to place limits on these central institutions and really watch them. There are also warnings to do with competition. So corporates, so the centrals in the US and for the credit union sector, got into enormous trouble during the financial crisis, whereas the ones in Canada didn't. And the reason being was that in Canada, you are legally obliged to become a member of your local central. So you have to just join your local one. There's no competition between centrals. In the US, you can shop around for your central. And so you're going to choose the central that offers you the highest returns. And so US corporates started getting involved with the sort of mortgage-backed securities that got everyone into trouble. So you've got to sort of, we need to be moving towards the centralized infrastructure, but we need to be keeping in mind the things that can go wrong as well. So just to sort of wrap up and go over what we've said, these institutions that appear to be just sort of on the margins in the UK, they really are actually prominent members of the financial system in other countries. So it's not an implausible dream that they could one day, that credit unions, for example, could one day be a real competitive force against commercial banks. But in order to do that, some progress has been made. We're starting to get better regulation, although we've also got to make sure that the regulation protects these institutions and values them and doesn't force them to become more like commercial banks, because we've seen in the UK, for example, our savings banks disappear and cooperatives disappear because they weren't really protected and they weren't acknowledged for the advantages that they gave. And we do need to look at more collaboration within the sector, but keeping in mind the pitfalls that emerge. And that also implies with regards to sort of what we ask for from government. So for example, in the past, the government sort of at the end of the 2000s created this growth fund, which put an enormous amount of money into individual credit unions in the UK. And they enjoyed enormous expansion. But the problem was it wasn't sustainable, because that money was specifically designed just to sort of meet the social targets and serve the social base, that credit unions are supposed to, and it didn't enable them to expand and get in the customers that they need to be financially sustainable. So instead, it's when you look at how Canada and the US have developed and where that sort of money and efforts have gone, the sector has really expanded when you've put effort into developing central infrastructure and developing like central regulation and legislation. And this is something that we're beginning to acknowledge with the Department for Wealth and Pensions beginning to has put out a tender recently for credit unions to see if they're interested in developing sort of things like centralised IT platforms. And similarly in Ireland, the Irish government has acknowledged that they need to start doing this, but we've obviously got to be very careful about how it's done. So thank you very much.
So very quickly, I'm going to, what is community finance and its underserved markets, and I'll come back to what I mean by that. And then essentially we split it into 4 markets: businesses, enterprise, civil society, organisations, individuals, homeowners. For each of those markets, I'll very quickly run through 4 areas, as you can see under the businesses, and then draw some conclusions and a comment on this study in particular, in terms of what it's found and some of the challenges of it. Okay, so this is our attempt to show the complex ecosystem called, community finance. At the top is the definition of community finance as CDFA use. And I think it's very useful. I just want to flag up 2 or 3 points about it. First point, it's about those who are unable to secure mainstream finance. Okay, so it's about those, those enterprises, those individuals who can't secure mainstream finance. And in the language of public policy economists, they're underserved markets because of it. Secondly, the point is that they're underserved markets. There are a variety of providers into that market. And the point about community finance is that they argue they distinguish themselves with the non-exploitative rate. So you're not the only providers into underserved markets, and that becomes an issue you'll see when I run through the presentation. And the third point about which distinguishes community finance is that you're about delivering, you have a mission, a social mission. You're about delivering social and economic benefits, not driven by financial return. So there's 3 elements actually inside that definition, which is why I think it's so useful. And you need to think about, we have to think about those 3 when we're trying to think about how we scale and scope community finance. You then get the ecosystem, as you can see, and as I said, we currently divided it into 4 distinctive markets. We had some fun with homeowners, and I'll come back to that at the end. Top line, however, just to, what did we find out in terms of trying to scale and scope? There is a gap. There's a community finance gap. Just to give you some scale issues against what the big banks are, as much as we can find reporting on what the big banks are up to in terms of what they're putting into the market, in terms of mainstream. But the key point for us was the challenge to estimate the current potential annual demand, 5.45 to 6.75 billion, and of course and our current assessment of what is being delivered into the market by yourselves and others around the table is about 0.7 billion. Quite clearly a community finance gap of some scale. And today is very much about trying to respond to how do we close that gap. Why does it matter? This is the other side. Why does it matter about closing that gap? It's because what you're doing is supporting the needs of the excluded from mainstream finance and delivering a variety of economic and social benefits. You're doing businesses which would not grow or would not be set up otherwise, supporting social enterprises to deliver new forms of public service, the whole way of economic and social benefits. And I think one of the vision of the community finance ecosystem is that actually if you bundle those economic and social benefits together, you start getting arguments about actually a sustainable economic development and social well-being at the heart of communities. In the language of government, the way we would articulate it is that that's an unmet demand. Those social and economic benefits which could be delivered are not being delivered because the demand is not being met. So there's actually a loss of economic and social benefits to UK economy and society. That's how the Treasury would look at it. And/or, in addition to that, there may well be ongoing costs to those economic and social benefits not being delivered. So moving to the individual markets, So what do we mean by the underserved market in business lending? So essentially commercially viable but unbankable businesses and nascent or discouraged entrepreneurs, those who want to start up but can't get funding to do so. Current market size, total investment about 100 million per annum. CDFIs are a core part of this, but you're also seeing some new entrants such as peer-to-peer and so forth. Potential annual demand, and this is where we get into the difficulties, 1.3 billion per annum from 103,000 clients. You have the report, as I understand it, you have the report in front of you, and you'll see in the report, you'll see how we've done that, how do we get to those figures. Just to give you an idea, in this case, it's basically taking all those, taking the national figures which show which in terms of SMEs, which SMEs are looking for external finance, those who are not financing themselves and have not been able to access mainstream finance. There's another bunch, about 20% who are seeking external finance, and then essentially saying if they if they came to CDFIs and were currently funded at the conversion rate, if all of those came through a CDFI door, currently CDFIs fund microfinance at 13% of inquiries going to loans. SMEs, it's 31%, and there's an average loan for each of those. So if you do those calculations, you get to a figure. So, and that is in there. So, this is the sort of approach we had to do. And I think the other key point is that we've always taken numbers which are publicly accepted somewhere, or are the strongest, because the key point about this is the range of stakeholders who have an interest in these numbers. Market developments, so we're seeing what we've been seeing in what was historically thought of as a relatively mature market, but actually, since the crisis and the recession and so forth, there's actually seen quite a large amount of change going on. But there is a long-run funding gap, we know that. Arguably, there's an upwards expansion in businesses who were previously bankable, have now become unbankable from mainstream. I think that partly explains why you've seen asset-based finance moving into the SME market, down into the SME market in terms of size. You've also seen payday lenders. This is an example of, is it an underserved market? Payday lenders are market-driven organisations, but they're not community finance providers. So that's where you get this importance about just thinking through where you sit in the market. You've also seen crowdfunding and angel. And there's someone from peer-to-peer, so I think there's a very big debate about whether crowdfunding is about funding the ones which banks would previously have funded, or whether it's actually going to fund into some of the markets where, the traditional microfinance markets. It's a very big argument. And you've also seen a variety of CSR market development activities by mainstream banks as well. But dependent, ad hoc, dependent on particular strategic initiatives at any point in time. Civil society, around 900,000 civil society organisations, from very small informal voluntary ones through to the largest charities. This is where the social enterprise, social ventures market tends to be sat. Similar finance issues to other SMEs, but obviously different types of business model and governance systems which cause problems for mainstream finance. And also this point about not being able to fund against social returns as against financial returns. And that's the tricky one which big society capital's currently working its way through, about the balance it wants between financial and social returns and how much it's willing to pay, essentially. Current market size, 286 million per annum. That was the figure from Boston Consulting Group last year. CDFIs, if you look at their latest survey, they're doing about half of that. Potential annual demand, between 0.9 billion to 1.7 billion per annum figure was the figure used for the state aid case for creating big society capital. Okay? Now when you dig around in there, there's some quite interesting assumptions, but essentially that's a number which has been accepted out there as the size of the market, so let's go with that. All the people who might fund into you are using that number. So, market developments, crowdfunding, obviously, the emergence of big society capital, a variety of new products like social impact bonds and payment by results, a variety of different, all sorts of schemes and pilots being tried out. Some growth in community investors as well, but in the end, tiny in terms, quite a large spike, but actually in terms of investment sizes. And again, the banks getting their heads around social enterprise. You've seen Santander, RBS, a number of them doing social enterprise initiatives, still trying to work out whether it's market development or CSR. I guess they'll make a decision in due course. But overall, the current social investment market remains nascent and the infrastructure immature. And that's the challenge. I mean, that's why we've got big society capital. They're going to try and turn this into a, that's the challenge, that's their objectives, to actually bring on the social investment market with a variety of yourselves. Personal lending, the underserved market, individuals without a bank account, underbanked, using high cost credit and in need of money advice, 8 million people in the UK. Current market size is between 3 and 3.5 billion per annum. That's in terms of total loan value, because essentially the money's getting recycled often several times a year through multiple loans. The average, I believe it's about the average client of payday lenders maybe do 3 to 3.5 loans a year, supposedly. Potential annual demand, and this again comes to what is the underserved market. There are payday lenders, so technically it isn't an underserved market. There is market provision. As community finance providers, we view that as exploitative. So it's certainly not part of the community finance provision. And the challenge is to, the ambition is to essentially remove, take some of that market share, make people utilise credit unions and community finance provision rather than going to payday lenders and high credit. Credit unions are the major providers. There is a current, but clearly, as Lydia pointed out, I mean, there are some issues for the fundamental issue, which is about their sustainability and their ability to grow. There's a consultation out, for example, around how much their interest are allowed to charge. And there's clearly unease expressed by politicians and regulators. Now again, they've tried the make information transparent. Tony laid out how does a market fail? Let's make information transparent. They clearly sit in windowless offices, because even though they've made information transparent, for some reason people keep using this high-cost lending. It's because it's easy, it's quick, and they're desperate. Okay, so they're now looking at other ways to try and but they're constrained in what they can do because it's around a market failure argument. Overall assessment, as Lydia pointed out, DWP has realised that they've expanded the credit union market in the UK massively, and there's a danger of them falling off a cliff. So they've put some more money in, but scaling it back and trying to drive the credit union system to sustainability. Homeowners, the underserved market. I mean, homeowners are unable to access grants or incremental credit, and without savings to tackle repairs or adapt their homes. We've had all sorts of problems with this market, and Louis and Naomi have helped us to try and articulate it better. Decent homes is simply bringing your home up to a standard. Current total investment is 15 million per annum, almost entirely by CDFIs. That's funded through local authorities, and local authority cutbacks have just been devastating. Energy efficiency, this is currently extremely live, and in principle, retrofitting and bringing up the standard of the housing sector in the UK to energy efficiency is a huge market, okay? And it's a market which is about social benefits, because it's about carbon reduction and affordable walls. However, there's the Green Deal Finance Company, which is being set up through banks and the major energy organisations, who will essentially be doing most of the finance loans to ordinary householders to try and deliver these benefits. Energy company obligation, this is where you're getting into some of the markets where community finance has been. But essentially, the obligation is that those energy companies are supposed to cover off all of that market. Okay? So arguably there is another provider called energy companies who are going to be in that market. The question is whether they can actually get to the vulnerable and the underserved, the traditional market areas with yourselves, and whether you will be there to support them. Under the old Green Deal, they failed miserably. Their targets failed, and on the quiet, government is looking at whether they should have regulated them. They're actually looking at whether they should have further regulated them to actually make them deliver. But if not, they may well be coming to the community finance providers to be the route to market. But in principle, they're supposed to be delivering into that underserved market through their obligation. So there are substantial opportunities, and the other point is, I would say, we're talking about homeowners here. It's quite a narrow market. There's all sorts of arguments around affordable warmth, social housing, affordable housing. They are different and distinct, and we haven't had the chance to unravel them, but I think it's important for the sector, rather than saying it's this big, to think through the relationships between those elements, and if you're taking our form of analysis. So what's the challenge? Moving community finance from a nascent ecosystem to a viable and established feature of the financial landscape. Challenge to policymakers to support provision for unmet demand against market failures and realise the extent and range of foregone economic and social benefits. A lot of language, that's the language of Treasury. You know, public policy can only intervene on the basis of there being a market failure, there being an underserved market, and that they believe that the economic and social benefits they gain outweigh the cost of the intervention. Talking of tightropes, we've been on a tightrope because as far as the banks are concerned, they hate the language of underserved markets and market failure, okay? So one of the things we've been very careful about is just trying to hold a tightrope between the variety of stakeholders who are going to use this document. The challenge for a partnership for community finance, given the shared common economic and social objectives for public, private and social, can you work together as the partnership? I mean, that's the opportunity you have currently. Government isn't going to do it on its own. It's looking for sustainability, but there are a variety of different investors, all who have a common cause here. So, you know, it's almost like, what's the hybrid system which can balance off those different objectives against the potential investment? Challenge to yourselves, I mean, there are visions of community banking system, putting together the variety of activities you do at a local level, expansion of credit unions and so forth. There's also the challenge of community finance as a concept, as an umbrella concept, and whether you can have internal and very active debates, but externally give a simple message which your variety of investors understand and can grab and utilise. A couple of comments on the study. You know, the challenge by Ben Hughes in the forward was the evidence we need to engage partners. Can we produce a set of figures which allow people to think harder and start to make business cases? This isn't definitive, but we've been very careful, and you'll see it in there, to try and only use a few numbers which have unequivocally been accepted by government, by stakeholders, okay? So they're in national surveys, they've been widely quoted. So it's a statement that banks, government and institutions can all work with. This issue of banks on the one hand don't like underserved markets, on the other hand, if you're in the Treasury, you need the argument of market failure of underserved markets, or you can't invest under public policy. I mean, two sides of the same coin. Fundamentally, the study fills a vacuum. I mean, that is clear that in the sense of there's a demand to try and get these numbers out there, and it is triggering a debate. And I would argue this is the first stepping stone. People can see the methodologies and they can find better numbers and they can develop it and push it on. But we've given a starting point. An obvious one is on the ground knowledge. You know, we're using material with express demand, people have other knowledges, but they need to be framed robustly, other a number of your investors will not accept those numbers. We tried to make the calculation methodologies as transparent. And I think the other key point is there are stronger data sources out there amongst yourselves, certainly within the banks and other mainstream finance. So that's an internal challenge just to help push that on. But whatever those numbers are, you can change those numbers by 10 or 20%, in terms of the document, but the message remains the same. The gap between what we believe the demand to be and the current supply is 10 times that order. Okay. Thank you very much.